was Paul Volcker in 1980, who allowed real interest rates to get to a positive 6 or 7%. The highest inflation got was 1981 at 13.5 by CPI, and we had interest rates at 20. You know, we're nowhere near there. We're still got interest rates half the inflation rate. And where's the cuts to government spending? I mean, you're not going to rein in inflation without getting to the source of inflation, which is government deficit spending. We just passed this omnibus Freudian slip, omnibus spending bill. You know, that's all financed by inflation. You can't fight inflation and create inflation at the same time. So I don't see any end in sight to the inflation spiral that's only now just getting started. And that's why it's so important that people act to protect themselves, because the vast majority of people are going to get eviscerated by what really amounts to a tax. I mean, this is how the government is paying for all the programs, all the spending. We're not getting anything for free from government. Everything government gives you costs money. And the way most people are going to pay for the cost of government is through higher prices. And we've only seen the beginning of the price increases that are coming. Again, remember, interest rates are another price too. I mean, if I'm a business, you know, I've got raw material costs, I got labor costs, I got rent, and I got interest if I've borrowed money. And as my interest rates are going up, I mean, that's another cost that I'm going to look to pass on to my customers through higher prices. So all else being equal, rising interest rates are adding to the inflation problem. The way rising interest rates are supposed to slow inflation is by slowing spending and increasing savings. That's what has to happen. But that hasn't happened. If you look at consumer consumption patterns, they're spending like crazy. The savings rate is near an all-time record low. It has collapsed. And credit card debt, mortgage debt, auto debt, student, all-time record high. So the rising rates have done nothing to alter consumer behavior. And so they're going to do nothing to bring down inflation. The only thing that's happened is we've had a pullback in commodity prices, oil prices, other things that moved up the most, the quickest, they've pulled back. And so that's creating some hope that maybe we've seen the worst of the inflation and now it's coming back down. But no, those prices are going to consolidate and hit new highs, probably even this year. And the other thing that's causing some hope is that real estate prices are finally coming down. But that doesn't matter, right? Real estate prices are not even part of the CPI. What's part of the CPI? Owner's equivalent rent. So, and you know, that still has a long way to go up. But the other factors that are there, utilities are in there, insurance is in there, maintenance costs are in there. All those things are going to go up. So even if the price of a house goes down, let's say a house that was $400,000 comes down to $300,000. It's actually going to be more expensive to buy the $300,000 house than it was to buy a $400,000 house a couple of years ago, because the mortgage rate is much higher, your insurance cost is much higher, your maintenance, your property tax. I mean, all the costs of home ownership are going way up. And Americans, most of them, they don't buy the house. They buy the monthly payment. Doesn't matter what the house costs. What matters is what do they have to pay every month to live there? And that's going to go way up, even as prices go down. And of course, the falling prices creates a big problem for the people who own homes, who have borrowed against the homes, or a big problem for banks who have loaned against those homes. And now the homes lose value. And the guys that live there don't want to stay there. And now they have to sell these homes in a market where mortgage rates are way up. And so people can't afford to buy them. So it's a real disaster that's coming in housing, but it's not going to reduce inflation. Inflation is going to go up even as the economy goes down. We're investing in international stocks. The foreign stock markets are off to a pretty strong start so far in 2023, and I think that's going to continue. There's going to be some bumps, especially as we get some big drops in the U.S. market that will pull down the foreign markets. But I think overall, the foreign markets will buck that trend. And I don't know how much the U.S. market is going to lose. I think we're going to make new lows in 2023. I think we're going to take out the 2022 lows. But by the second half of the year, if the Fed is back at QE, that could put some type of floor beneath the broader averages. And so maybe we could end the year a bit higher, but we could also end it quite a bit lower. But I think adjusted for inflation, I doubt the stock market will beat inflation. And I think the stocks that most people own, like the FANG stocks, those stocks are going to go down. I think they're going to have another bad year, just like they had a bad year in 2022. I think they're going to have another bad year in 2023. But I think the international stocks, the stocks that we're buying that benefit from inflation, and there are a lot of companies that are positioned to do that, we own those stocks, and I think their prices are going to keep going up. Many of the stocks that we own are hitting 52-week highs this week, and headed higher. And I think, in particular, some of these gold names, I mean, they're still well below their 52-week highs. That's how much they went down in the last year, but they're miles above their 52-week lows. So they're in really big bull markets, but they're still very cheap. They still have a long way to go to get to fair value. That's the opposite of the tech stocks. The tech stocks are still very expensive, and they have a long way to fall to get to fair value, let alone cheap. The gold stocks still have a long way to rise to get to fair value. In fact, they can rise a lot and still be cheap. I think that's how inexpensive they are. So there's an opportunity. And, ironically, you had a lot of people who were worried about inflation, worried about the Fed, worried about the dollar. But instead of buying gold, they bought Bitcoin. And they're also going to lose a lot of money in 2023. I mean, Bitcoin was down 75% or so in 2022. It could be down that much again in 2023. It could be down more. And of course, a lot of people are losing all their Bitcoin because they put it with a custodian that went bankrupt. So in which case, your Bitcoin is already worthless if you don't have it. But even the people that still have their Bitcoin are going to lose money because the Bitcoin itself is going to lose its market price. Because that's all it has, right? Bitcoin has a price. It actually has no value, but it has a price as long as people are dumb enough to buy it. But eventually, people wise up. They're not going to stay dumb forever. Yeah, look, the Federal Reserve has turned the market into a casino, and it's really helped undermine the productivity of the American economy, which is one of the reasons why we have huge trade deficits and the economy is so, screwed up, is because of this bad foundation. And the Fed should be irrelevant. Nobody should be making investment decisions based on the Fed. But right now, the Fed is the only thing anybody cares about. Like, are they going to raise rates? By how much? Are they going to do QE? I mean, the fact that everything is riding on the decision of a few guys sitting in a room in Washington, D.C., that's not how capitalism is supposed to work, right? And if you think about what these guys do, they sit in a room and they decide the price of money. They decide the quantity of money. Why? Why should they make these decisions? I mean, that makes no more sense than having a bureau put together to decide the price of oil or the price of milk or the price of bread. Why don't we do that? Why don't we have government bureaucrats figuring out what prices should be? After all, wouldn't it be better if, some prices were lower? Why don't we set the price of oil at 50 cents a gallon, right? That'd be great, right? It would be a lot cheaper. Because we can't do that because it creates distortions. It creates problems. We know that we have to let the market discover the price. We just can't set the price. That's what the Soviet Union used to do. And it was a disaster because you waited in line for 4 hours you didn't even know it was at the end of the line. You just waited in it if you saw it because you figured maybe there was something you needed. And what was there? Maybe they had rotten apples, but rotten apples were better than no apples. So you waited in line for 4 hours to get some because, they were cheap, but you spent a lot of time getting them and they weren't very good. So we know that we shouldn't fix prices, yet everybody thinks that it's a good idea to let government bureaucrats pick the interest rate. Why? I mean, you've got to figure that since money is half of every transaction and interest rates are really the price of money, the government is basically fixing every transaction we make. That makes no sense. If you believe in capitalism, then you don't believe in the Fed. And when the Fed creates problems, when it creates booms and busts, you can't blame that on capitalism because under capitalism, there is no Fed. This is the government. This is socialism. We have socialized that market function of interest rates. And we've got all the distortions that you would expect whenever you have price fixing. What do we have a shortage of? We have a shortage of savings. We have a shortage of real goods production. What do we have a surplus of? Debt, consumption, speculation. There's bubbles everywhere. These are not happening by accident. They're happening because of the Fed. And so they need to take a step back and undo all the damage that they've done. Now, that can't be done in isolation, right? In order to do the right thing, there's going to be a lot of short-term pain, which is why we never do the right thing. Politicians don't want short-term pain, even if it leads to long-term gain, because they don't care about long-term gain, because they may not be in office if we have the short-term pain. So what they would rather have is less pain now, even if it means more pain later.